Welcome to the first session on commodity derivatives and risk management. Before we go into more details of what are commodity derivatives and how these commodity derivative contracts can be used to manage price risk, let's understand what is a commodity. How do we define a particular asset to be a commodity? Let's go to the definition which is normally given in textbook. That is, commodity by definition is a good which is produced by many producers, companies and firms without any qualitative difference, and the producer cannot be identified by examining the goods. Here I would like to stress upon the set of words that is without any qualitative difference. Let me pose a question to you. Let's say you go to your neighborhood grocer and ask for a packet of or 1 kg of sugar. And when the grocer delivers you the packet of sugar, merely examining the packet, would you be able to tell which sugar miller in India has produced this particular packet of sugar? According to ISMA, that is your Indian Sugar Mills Association, India has 211 sugar millers, and this particular packet which you are holding in your hand could have been produced by any one of the miller. So that is where a commodity derives its definition, that it is a good which is produced by many producers and companies and firms, we cannot distinguish the produce by merely examining that particular product or the underlying asset which we are holding in our hand or which we are examining. Similarly, the same thing is applicable to moong dal, maybe rice, maybe almonds, cashew nut, raisins, many things which we buy from the neighborhood shops. We will not be able to say who is the producer of that particular commodity by merely examining that product which we are holding in our hand. Taking that example to further, a ton of steel or gold produced anywhere in the India or world can be treated as a commodity, or a ton of copper or rubber produced anywhere in the world can be treated as a commodity. Let's say, let me ask a question to you. There are 6 pictures of different commodities or different items given here. A picture of a car, different sizes of diamond, different shapes of diamond, and you have a steel rod here. You have a bar of 2 bars of gold. You have a bar of copper, and you have a gold jewelry. If I ask a question, can you identify which set of commodities, which set of items can be grouped as commodities? Will you be able to do so? Okay, let's go to the answer. A car can never be treated as a commodity. Similarly, the necklace or jewelry piece will never be treated as a commodity, because this jewelry piece will always be marked with the name of the jeweler who has manufactured this particular jewelry. Besides these 2, others can be treated as commodity, because by physically examining these assets, we will not be able to tell who is the producer of this particular this commodity. Now the next question is that why should we learn about commodities or commodity derivatives at this point of time? Human beings have traded commodities since since the beginning of the mankind. What is so new about commodity trading or commodities or commodity trading? the new dimensions which has prompted us to learn more about commodities are that commodity derivative contracts have started getting traded in exchanges. Commodities are traded in the local market, in the spot market from time immemorial, as mentioned. However, commodity derivative contracts are started getting traded in commodity exchanges, and commodity prices are increasingly becoming volatile. So let's go to this particular link. This link indicates the commodity spot price indices for three underlying commodities. One is a commodity fuel index, and the second one is a commodity food price index, and third one is a commodity metal price. All these indices have been benchmarked to the value of 100 in the year 2005. That is, the base year has been equated to 100 value, and the base year is 2005. And analysis of this particular figure or picture, we can, it is very clearly visible that the commodity prices has remained almost stable since 1992 till probably maybe in January 2004-05, but subsequently you can see a great deal of volatility in all these three indices. The second picture or the second graph represents the annualized return volatility of these three indices, and as can be seen that the volatility of these return volatility of these three indices has increased as the years have gone by. And from where have I collected this data? The data source is from International Monetary Fund, and the link to the International Monetary Fund is, it's given here. So why we need to understand about commodities or commodity derivatives is that commodities prices are increasingly getting volatile, and to mitigate the price risk associated with these commodities, commodity derivative contracts are getting available in commodity exchanges. In fact, earlier many countries did not have a commodity derivative exchange, organized commodity derivative exchanges. With the progress of time, with the volatility of commodity prices increasing day by day, almost all major commodity producers of the world have started their own commodity exchanges. So that is the reason why it becomes, it is quite important for us, or even for consumers and producers of commodity, to understand what factors are contributing to the volatility and how commodity price risk can be mitigated. The second aspect the second set of aspects which has made commodities more interesting of late is that commodities are emerging as a new asset class. Many investors are interested to hold commodities in their portfolio because commodities tend to exhibit negative correlation with most other asset classes, like which we normally hold in our portfolio, like our equity, bond and real estate. So almost all these financial asset classes tend to have a negative correlation, and there are many research studies which are corroborating to this negative correlation. And commodity investment also provide an effective hedge against inflation. That is, whenever inflation rises, commodity prices also increase. So these two combination, these two facts, that is, commodities exhibit negative correlation with most other asset classes, as well as commodities are an effective hedge against inflation, are contributing towards many investors getting interested in investing in commodities or adding commodities to their portfolio. However, commodities in its actual form, that is real underlying assets, cannot be held directly by investors. So normally investors have started investing in commodity derivative contracts, that is your commodity futures and options, to benefit from the diversification of portfolio, and they are adding these commodity derivatives to their portfolio. Now let's spend some time in understanding what exactly is a derivative. I'm sure all of you must be knowing what is a derivative, because this particular subject requires a prerequisite of understanding of financial derivatives such as options, futures and options. However, at this point of time, I would like to briefly take you through what is the difference between financial derivatives and commodity derivatives. Let's understand what is a derivative. A derivative is a contract which derives its value from an underlying, and to be very simplistically, if we can put it, in an index, popular indices like Sensex and Nifty can also be treated as derivatives, because they derive their value from the share prices of the underlying companies which constitute these two indices. However, we normally do not categorize these indices as derivatives. We categorize derivative contracts or financial derivative contracts as we normally categorize forwards, futures, options, swaps, etc. as derivative contracts. And when we are talking about financial derivative contracts, those derivative contracts have stocks, bonds, foreign exchange and interest rates as underlying. And commodity derivative contracts, as we have discussed earlier, commodity derivative contracts have commodities as the underlying. And what do we mean by what are the different types of commodities on which we have commodity derivative contracts available? That we will discuss little later. In commodity exchanges, futures and options on various types of commodity contracts are trading, such as gold, silver, agricultural commodities, and many other different types of commodities which are available for trading in many commodity exchanges all over the world. Besides standard commodities, commodity contracts on exotic commodities such as carbon credit, hurricane, electricity, rainfall, payroll, freight rates, real estate, etc. also have started trading in various exchanges, and giving different opportunity to diversify their portfolios. So a lot of investors, a lot of traders are entering into these trading in these commodity contracts to earn some extra return, which helps them in getting a better return from their portfolio. Having discussed what is the difference between commodity derivative and financial derivative, I would like to spend some time on understanding what is the difference between a commodity spot exchange and commodity exchange. So when we use the word commodity exchange, we normally mean it's an exchange where derivative contracts such as futures and options on commodities trade. In India, we have two well-known commodity exchanges, that is your MCX and NCDEX India. Globally, as I mentioned earlier, that almost all country has now have now commodity exchanges. Some of the important or popular commodity exchanges are CME, that is Chicago Mercantile Exchange, Tokomo, Tokyo Commodity Exchange, and the Intercontinental Exchange and Shanghai Futures Exchange. And one thing I would like to point out here is that in Chicago Mercantile Exchange, not only commodity contracts trade, also financial contracts trade in this particular exchange. Now let's focus our attention towards understanding what is a spot exchange or a spot market. In a spot market, buyers and sellers exchange goods for immediate delivery, which does not happen in case of a commodity exchange, in which buyers and sellers enter into a contract where the underlying asset or underlying commodity is supposed to be delivered at a future point of time. In a spot exchange, buyers and sellers exchange goods for immediate delivery. Let's say buying 2 kgs of potato from our neighborhood shop can be treated as a spot market, and a farmer which is selling probably 200 quintals of potato to a wholesaler in a local mandi is also treated as a spot market transaction. Earlier in India, the spot market or wholesale market transactions were predominantly done on face-to-face basis, where buyers and sellers used to congregate at a local mandi or local wholesale market, and the price were negotiated open and between the buyers and sellers, and they were commodities were exchanged. Commodities were exchanged, as well as subsequently price exchange was happening between the buyers and sellers. However, with the advent of technology, internet technology, a lot of these wholesale markets or mandis are using e-auction platform and bringing in buyers and sellers from far away places, and buying and selling is happening between these buyers and sellers. So, but these, even if these markets have used or are using online trading facility, they are still providing a platform for exchanging the underlying goods which are treated as a spot transaction. In this context, I would like to share the development happening at 2 spot exchanges, online spot exchanges, that is your NCDEX E-Markets Limited and Rashtriya E-Market Services Private Limited. These are the 2 exchanges, spot exchanges, which are using online technology e-auction platform to bring buyers and sellers and providing a better facility to buyers and sellers, so that each buyer has access to more number of sellers and vice versa. And those who are interested to learn more about these 2 spot exchanges and how these 2 spot exchanges are using technology to bring more buyers and sellers to this common platform, they can spend some time. The links are available in these 2. I have given the links to the respective websites as a hyperlink to these bullet points. In a nutshell, what I would like to share about these spot exchanges are, spot exchanges are providing an e-auction platform. In this e-auction platform, a seller solicits bids from the buyers and sells the underlying goods to the highest bidder. And similarly, a buyer solicits bids from the seller and buys the underlying commodity from the lowest bidder. So it is nothing new. Traditionally these wholesale markets or mandis used to do the same thing, but probably the participation was limited to the local buyers and local people, local traders. with the facility, with the online trading facility, now these spot exchanges are reaching out to more buyers and sellers. In this context, I would like to mention one interesting aspect, how Food Corporation of India is using the NCDEX e-market platform to undertake its open market sales scheme. Food Corporation of India sells wheat to bulk consumer and traders as part of its open market sales scheme through e-auction platform of the NCDEX, and using this platform, Food Corporation in India announces that it intends to sell, let's say, X tons of wheat from a specific go down on such and such date, and the panels and the buyers who have been who have been approved by the NCDEX can bid for those whatever amount of wheat Food Corporation India has announced, and accordingly Food Corporation India sells the wheat to the highest bidder. So to summarize what we discussed till now, is that spot exchanges are exchanges where, or markets where buyers and sellers meet, or buyers and sellers come to an online e-auction platform for trading the commodity for immediate delivery. However, commodity exchanges offer derivative contracts on futures and options, where buyers and sellers can use these contracts for delivering the goods, or buying or selling the goods at a later point of time. Now let's go to the historical perspective of commodity exchanges. Are the commodity exchanges new? Commodity exchanges are fairly new. What we are seeing in terms of MCX, NCDEX, etc., commodity exchanges are fairly new. However, globally, commodity exchanges are there for substantial period of time, as this particular slide indicates. The earliest recorded futures exchange is Dojima Rice Market of Japan, which started in the year 1730, which offered futures contract on rice. You have Baltic Exchange started from 1744. You have Chicago Board of Trade starting from 1849. You have Argentina's Bolsa de Cereals starting from 1854. You have London Metal Exchange, which started its operation in 1877, so on and so forth. Other exchanges are also mentioned. And one interesting aspect is that some of these exchanges may not be available by the same name, because other exchanges have acquired them. However, Baltic Exchange and London Metal Exchange are still operational, offering futures and option contracts on different types of underlying, and they still operate in their own name. Historical perspective of commodity exchanges in India, and though we are talking about multi-commodity exchange and NCDEX very recently, India had a very long history of commodity derivatives trading. Bombay Cotton Exchange started in the year 1893, and it offered futures contract on cotton. It seems by 1939 there were around 300 commodity exchanges in India. Some of the important ones I have just listed here. These are Gujarat Bapari Mandali, Calcutta Hessian Exchange Limited, East India Jute and Hessian Limited, Indian Paper and Spice Trade Association. So all these 300 commodity exchanges were operating in isolation. They had their own rules and regulations pertaining to contract specifications, margining system, the trading and settlement rules. So Government of India felt the necessity of harmonizing the rules and regulation of commodity derivative trading, and in the year 1952 Government of India enacted a Forward Contract Regulation Act of 1952, and it instituted a regulatory body called Forward Market Commission, and this commission became the regulator of all commodity exchanges operating in India at that point of time. However, because of various reasons, historical various reasons prevailing at that point of time, Government of India brought in a comprehensive ban on trading of all agricultural commodity derivatives in the year 1969. The predominant reason which are cited in research papers and websites are that commodity derivatives were perceived to be increasing the volatility in agri-commodity prices. So Government of India decided to put a comprehensive ban on commodity derivative trading. However, it did not scrap the Forward Contracts Regulation Act of 1952, or it did not do away with the Forward Market Commission. Forward Market Commission remained as a regulator of commodity derivatives market. Whatever derivative trading was happening in whichever exchanges from 1969 till Forward Market Commission got merged with SEBI in 2015. During this, since post-independence, Government of India appointed many committees to look into various aspects of commodity derivatives trading. Some of these committees are Prof Committee, Dantwala Committee, Khusro Committee, Kabra Committee, Expert Committee on National Agriculture Policy. At this point of time, I would like to mention that Kabra Committee and Expert Committee on National Agricultural Policies gave recommendation regarding restarting of commodity derivatives trading in India, and based on these recommendations, Government of India brought in regulations to create national level multi-commodity exchanges. Based on those regulations, in the year 2003, NMCE and NCDEX and multi-commodity exchanges came into picture. And subsequently, Indian Commodity Exchange Limited came into operation in the year 2009. However, as of today, majority of market shares are owned by majority of market share in commodity derivative trading is with multi-commodity exchange and national commodity derivative exchange. As I mentioned earlier, Forward Market Commission merged with SEBI, that is Security Exchange Board of India, during September 2015, and from September 2015, Security Exchange Board of India has become the regulator of India's commodity derivative market. Besides this national commodity derivative exchanges, India also has certain regional commodity exchanges. For example, the Ahmedabad Commodity Exchange offers contracts on castor seed. You have Rajkot Seeds and Oil and Bullion Merchant Association. Rajkot offers castor seed, and the South Indian Cotton Association Coimbatore offers contracts on cotton. What is the major difference between a national level commodity exchange and regional commodity exchange is this. Regional commodity exchanges can offer contracts for which they have been permitted by the regulator. For example, let's say regulator has permitted commodity derivative contracts on 15 commodities in India. National commodity derivative exchanges like NCX, NCDEX, etc. will be able to offer contracts on futures contracts on all these 15 underlying commodities. However, regional commodity exchanges have to get approval or license to offer contracts on each of the commodity in which they are interested to offer derivative contracts. Also, one thing I would like to highlight here, even though I am using the word futures and options many times in the context of derivative commodity derivative trading in India, as of now, commodity market regulator has not given sanctions to offer options contract on commodities. We have in India currently only futures contract available for trading. Now let's focus on what are the different kinds of commodity underlying which are offered by major commodity exchanges all over the world. And this is one thing I would like to again stress upon. These commodities are nothing peculiar. These are commodities which are not these commodities are available in major commodity exchanges all over the world. So in agricultural food category, you have maximum number of contracts. You have livestock and meat category. These contracts are predominantly available at Chicago Mercantile Exchange, with wool is available at Australian commodity exchanges. Fuel, that is gasoline, kerosene, crude oil, diesel, ethanol, etc., available almost all commodity exchanges in the world. Metals, gold, silver, platinum, steel, scrap, copper, lead, zinc, etc. are also traded in many commodity exchanges all over the world. However, London Metal Exchange is predominantly known for base metals, commodity contracts on base metals, and other non-conventional products like weather, emission, electricity, ocean freight, real estate, water, payroll, etc. are traded in many exchanges. In the agricultural and food category, those commodities which are written in red font, that is almond, chana dal, jeera, turmeric, barley, coriander, etc. These are contracts which are very, very specific to Indian market, and I don't think any other commodity derivatives in commodity exchanges in the world offer commodity contracts on these underlying, and this shows the vibrancy of our taste and our food habit, and this is something a very, very beautiful aspect of being in India or being Indian, that you get to taste, or your food preferences are quite wide and quite vibrant. Now in the next section, we will start what are the value propositions provided by commodity derivative exchange. So to summarize what we have discussed for this particular session is that commodity derivative exchanges are different than commodity spot exchanges. Commodity spot exchanges, in commodity spot exchanges, buyers and sellers congregate or meet or come to online e-auction platform where the price is arrived for immediate delivery. However, commodity exchanges offers commodity contracts on futures and options, and we also discussed historical development of India's commodity derivative market, and also the difference between a national level commodity exchange and regional commodity exchanges. As I mentioned, in our next session we will discuss what are the value propositions, what benefit commodity exchanges provide to traders.